Hey guys, it's Rudy coming at you live from Lake Worth in Florida. I want to talk a little bit about REITs. For people who've been watching the channel, sometimes they comment and they say, "Hey, Mr. Oxy, you sure like dividends?" Well, you bet. Dividends is an easy way to hedge against market volatility, and it's also an easy way for you to keep building your portfolio over time, especially if you have the ability to reinvest the dividends. One of the best ways of earning dividends is by investing in REITs. Real estate investment trusts vary, they're not all the same, and you have to be extraordinarily careful, especially today, because commercial real estate is pretty much not something that you want to be investing in right now or at this time. But what I want to do is just take a few minutes and talk about REITs and make sure that everyone on the channel is as familiar with a real estate investment trust as what I am, and what I'd like you all to be. A security that trades like a stock, right? So you can buy a REIT, so a real estate investment trust, on the stock exchange. You can buy it the same as any other stock. And this is important because instead of investing in real estate being bricks and mortar, where you actually own the actual building and the physical footprint, and maybe you want to rent out that office space or retail space or something, whatever it is, to somebody else, and hopefully the tenant pays you and doesn't abscond without paying you or doesn't damage your property or whatever the case might be. Instead of incurring the risk of becoming a landlord, you can just buy a REIT, and that way you can become a landlord without actually owning the building. You just own the real estate investment trust. Of course, it's also instantly liquid, unlike owning fixed real estate, because if you need cash, you could just sell those securities. In other words, you sell the equity and you can just cash out anytime you want. REITs receive special tax considerations and offer investors real estate equity investing with liquidity. And so I just mentioned that, right? So the difference between the two is very, very significant. In the first place, if you own real estate, you actually are geographically locked into a particular area or geography. In other words, your real estate is wherever it is located, and you're kind of stuck. So if that market booms, that's fantastic. That's great. If the market tanks, then you can't do anything about it. So if you own property in an area where the real estate is not doing well, and you happen to own some kind of a property there that's meant to be an investment property, then just too bad. On the other hand, if people flock there and start buying the real estate and the prices go up and there's demand for it, then that's great. The difference is if you own real estate investment trusts as opposed to owning the fixed property, as I said a minute ago, you could just cash out anytime you want. REITs must invest in real estate and derive the majority of the income from real estate activities, including earning rents, for instance. It's the most common REIT, right? So they buy a whole lot of commercial properties. Those properties are rented out to individual tenants. Those tenants hopefully pay on time. And when the REIT collects the rent, they pay some of the money back to their investors. REITs are not typically taxed at the entity level, so in other words, not the corporation, allowing investors to avoid double taxation on their dividends, which they earn. A REIT must pay out 90% of its annual taxable income on dividends. Due to the structure, they typically pay out a higher rate of dividends than typical equities. Dividends received from REIT holdings are taxed as regular income. That's a little bit of background here. So let's look at the first some benefits related to REITs, and some of them I've just discussed a minute ago, but let's talk about this very briefly. Potential for much higher yield. REITs pay much higher dividends typically than most common equities. Very few equities pay as high a dividend as a REIT. They are accessible. It's easy to trade them on any exchange wherever they do their trading, where the security is traded, and you can diversify because it's not one type of a REIT. So if you want to stay away from commercial, but you want to invest in something else, I'm going to talk about that in just a minute. You don't have to be stuck in a market segment that is perhaps down the tubes right now. In fact, there are two ways to look at it, right? You could say, I don't want to invest because commercial real estate is crashing. Or on the other hand, you could say, I want to invest because commercial real estate is cheap. I can't make that decision for you because I don't know anything about your particular unique situation. It's inflation hedging as well, because it gives you a hedge against rising inflation rates. That's a bit of a two-edged sword, because very often when the inflation rates rise, some of the landlords have to increase the rents for their tenants because the inflation rates are higher and they have mortgages on those properties. The tenants cannot afford to pay, and you end up with vacant properties that cost you money. What are the risks? Real estate risk, so I talked about that a little bit. Many different reasons why. Fluctuations in property value, leasing, occupancy, geographic demand, etc. These are common risks. Interest rates, we talked about as well. If the interest rates go higher, it's not a very conducive market for you to want to invest in, because it trickles down to everybody, including the tenant, who you hope to collect monthly rent from if you own the property yourself as opposed to the REIT. Occupancy rate risk. How much vacancies are you having to carry? What are the lower rents that you might be forced to accept? And then what is the geographic risk, right? We talked about that too. It's great if people are flooding there and there's lots of jobs and people want to go there. The inverse is true when people are leaving the area. So right now, for instance, in New York City, people are leaving, they're not arriving, right? So any REIT that was specifically invested in commercial real estate in New York City is pretty much right at the bottom of the barrel. Different REIT sectors though, right? So it's not all the same thing. I have 4 of them here. So commercial includes the things that most people are most familiar with when it comes to REITs, like shopping malls, office buildings, strip malls, etc. Extreme caution right now. These are commercial real estate properties. Vacancy rates are high. Tenants are defaulting, businesses are defaulting, filing for bankruptcy, etc. Not a good time for commercial real estate REITs right now. Healthcare. This is a significantly better category of REITs to invest in at this time, at this moment. It includes senior living facilities, hospital, medical office buildings, and skilled nursing facilities. There's growth here. And of course, as the population ages, like yours truly, there's more opportunity for investment in healthcare REITs than what there was before. So commercial, extreme caution. Healthcare, on the other hand, growth, mainly because of seniors and a variety of other related facilities or reasons why. Then there are residential REITs. These are automatically lower risk because people, even when they lose their job, would be inclined to want to save their home, right? You have to live somewhere. So the last thing you want to do is go and live under a bridge somewhere. So if you lose your job, you can go look for another job. You don't want to lose your home. So as a general rule, REITs that are invested in multifamily apartments, duplexes, student housing, etc., and even single-family residences are lower risk than commercial at this moment in time. And then there's e-commerce, which is relatively new in terms of the sector, but these REITs include data centers, industrial infrastructure categories, etc., that show growth in e-commerce. This is a growth area. It's lower risk. It includes cell towers used to relay e-commerce orders, warehouse distribution, logistics facilities, etc., for e-commerce goods. So something like an industrial e-commerce facility could include a commercial warehouse for Amazon. So if your REIT is providing that type of an investment opportunity, that's not bad at all, and much better than a financial services sector company, for instance, who was headquartered in New York City. And just by way of an example, so I'll take one company that I'm relatively familiar with, like AllianceBernstein. They were headquartered in New York. They moved to Nashville, right? So you just end up with an empty office building. Not good. So, but great for Nashville, right? So there's a bit of a sort of two-edged sword there. 7 of the best REITs stocks to buy right now. So I went to Morningstar as one of my sort of trusted go-to places, and I basically Googled it within Morningstar, not Googled, but I searched and said, what are the best REIT stocks to buy? They actually published a list of 7 of them, so I'm not going to go through all 7 of them, but let's talk a little bit about the top 3, right? So Morningstar is basically saying that these 7 REIT stocks below are trading at large discounts to Morningside's fair value estimates as of June 2024. What is a fair value estimate? Fair value estimate is Morningstar's analyst estimate of the stock's intrinsic value, or what the stock is worth in the long term. Morningstar analysts use a proprietary discounted cash flow model, DCF, right? Discounted cash flow. The problem with the discounted cash flow model is you have to make many assumptions, and 90% of the time your discounted cash flow is absolutely wrong. Sometimes it's not badly out of whack, sometimes it's horribly wrong, and 10% of the time it's reasonably accurate. The 3 top ones here, Pebblebrook Hotels, Kilroy Realty, and Park Hotels and Resources. Just look at them for a second here. So I'm looking at a 1-year period, and Pebblebrook is down 6.8%. The next earnings date, July 24th, right? So it's right here, right now. And then the dividend is actually almost nothing. So this is a stock that's been underperforming, and in addition to that, it hardly pays a dividend. So Pebblebrook Hotel Trust, despite the fact that it's trading well below Morningstar's intrinsic value estimate, is not a stock I want to go anywhere near to. In addition to that, it's hospitality because it's hotels, and I would not want to be investing in hotels at this moment in time, whilst we are in a high inflationary cycle and there's very little disposable income available for people. So what's going on with Pebblebrook? So in June 14th, so on June 14th, just a month ago, they declared a quarterly cash dividend of 1 penny per common share of beneficial interest to be paid on July 15th. That was a week ago. So every shareholder got just 1 cent, right? If you're holding cumulative redeemable or preferred shares, you actually earned a reasonably decent dividend, which is similar to the dividend that they previously used to pay as a cash dividend to common stockholders, but they don't do that anymore. It's a hotel trust. They're not doing very well. And despite the fact that it's trading well below its intrinsic value, I wouldn't even buy this with your money. How about Kilroy Realty Group? So its earnings date is coming up soon on July the 31st. It pays a dividend of 6.7%, which is really good. Many times when I speak to real estate property owners, I ask them what kind of a cap rate are you looking to achieve? Cap rate, a capitalization rate on their income generating properties. And if they can get a high number like 6, 7, 8%, that's great. If they can get 10 or greater, that is fantastic. It's not easy to achieve in this kind of a market. And you can see, even though its 1-year performance is up a little, 4%, it's not very good at all. But at least you can add the 4% stock appreciation to the 6% dividend, and you above 10%. And now suddenly your cap rate is looking pretty good because it's in double digits at around 10 or 11%. So Kilroy Realty looks a lot better than Pebblebrook. How about Park Hotels? Now, once again, we here with a hotel and resort REIT. It's up 4% for the past 1 year, and it also pays a dividend of 7%. So if you take the 7% dividend plus the 4% stock appreciation over the 1-year period, you're up about 10%. Most real estate property owners who are renting properties to, especially in the commercial sector, would be happy with 10, 11% if they can generate that. Which begs the question, why would you buy property at all when you can just buy this REIT and generate, in this case, and in the case of the previous one, around 3, 4% stock appreciation plus a dividend that is almost fixed income and guaranteed for you unless it's cut, like Pebblebrook Hotels, and then you're making nothing. But on these, at least you're making 7%, so they're not bad at all. If I overlap them, you can see they pretty much form the same trajectory, except that Kilroy was actually doing sort of okay, and then, or better than the other two, and then they all kind of just went along one with the other. And this is over a 5-year period. So if you were holding these for the stock appreciation, you've pretty much lost your shirt because they're all down 50% over the last 5 years or so. So if you had listened to someone like myself on YouTube saying 5 years ago, buy REITs, they pay high dividends, you should want to hold this this REIT. Even after you've earned your dividends, you might be just kind of treading water because you haven't made a return on your investment at all, because from a stock depreciation point of view, you're down 50% regardless of what happened to your dividends. And if your dividends were cut, like it was in the case of Pebblebrook Hotels, then you are down 50% and you no longer earn a dividend at all. So you don't even have that as a little hedge to protect you. So I don't know if you guys are in REITs at all. If you are, and you have a good REIT that might be of interest to our people on this channel, let us know. And of the ones I shared, are they buys, holds, or sells? If you hold any of them, maybe you can tell us why. And if you don't, would you even open a position in any of these? But more importantly, if you do hold a REIT in your account and it's been performing really well and you like it and it's been paying you a good dividend, and in addition to that, you've had good stock appreciation, share it with the channel so that we can all use that information in order to add it to our watch list and make our portfolios look a little bit better over the long term. Thank you for watching. Take care. Bye-bye.